In the summer of 2000, Enron's stock hit $90 a share. 18 months later, it was worth 26 cents. That's not a market correction. That's not a recession. That's complete obliteration. And it wasn't just numbers on a screen. Couples who'd worked at the same company for decades watched $800,000 in retirement savings vanish in weeks. Grief counselors were brought in, not for layoffs, for financial devastation so severe people couldn't function. This is the story of how the seventh largest company in America convinced the world it was inventing the future, and how, when the lies finally collapsed, it took down not just itself, but one of the world's most respected accounting firms, triggered new federal laws, and became the textbook definition of corporate fraud. Before Enron became a punchline, it was untouchable. Fortune magazine named it America's most innovative company 6 years in a row. Wall Street analysts called it a revolution. The company's executives appeared on magazine covers. Jeffrey Skilling, the CEO, wasn't just running an energy company. He was supposedly reinventing how markets worked, and people believed it, because on paper, Enron was making billions. Except it wasn't, not really. Here's what actually happened. In 1985, Kenneth Lay merged two natural gas companies to create Enron. For the first few years, it was boring. Pipelines, gas, infrastructure, the kind of business your grandfather would understand. Then in 1990, Lay hired Jeffrey Skilling, a McKinsey consultant, who had an idea. What if instead of just moving gas through pipes, Enron became a middleman for energy trading? What if it created markets where none existed? Wall Street loved it, the stock climbed, and Enron got greedy. By the late 90s, the company wasn't just trading energy. It was trading weather derivatives, broadband capacity, advertising space, anything that could theoretically be turned into a financial contract. Enron claimed it could trade. The problem? Most of these businesses didn't actually make money. But Enron had figured out how to make them look profitable, and that's where the fraud started. Let's talk about how they did it. First, mark-to-market accounting. Normally, if you sign a 20-year contract to supply energy, you record the revenue as you actually earn it year by year. That's how accounting works. But in 1992, Skilling convinced the SEC to let Enron use something called mark-to-market accounting. This allowed the company to book the entire estimated value of a contract the day it was signed. Not when the money came in, not when the work was done. Immediately. So if Enron signed a deal it thought would make $100 million over 20 years, it could claim that $100 million on day one. See the problem? Those estimates were based on projections, assumptions, guesses about the future, and Enron controlled the guesses. If a deal wasn't profitable, they'd just change the assumptions until the math worked. Then they'd report it as income. It was legal, technically, but it let Enron turn imaginary future profits into real present-day stock price gains. Now add the second trick: special purpose entities. Enron created hundreds of off-balance sheet partnerships with names like Chuco, Jedi LJM, and Raptor. These entities existed for one reason: to hide debt and inflate profits. Here's how it worked. If Enron made a bad investment, it would sell that investment to one of these special entities. The entity would pay Enron, Enron would book a profit, and the bad asset would disappear from Enron's books. But who funded these entities? Enron did, using its own stock as collateral. So Enron was essentially selling bad investments to itself, using its own stock as payment, and calling it profit. As long as Enron's stock price kept going up, the whole system worked. But the second the stock price fell, the entities would collapse, and all that hidden debt would come crashing back onto Enron's balance sheet. Andrew Fastow, the CFO, ran these partnerships, and he made millions in side deals for himself while doing it. Third trick: stock-based compensation. Enron paid its executives in stock options, lots of them. The higher the stock price, the richer they got. So executives had every incentive to inflate earnings, hype the company, and keep the stock climbing, even if it meant lying. And they did lie. They lied to investors. They lied to regulators. They lied to their own employees. And for years, it worked. By 2001, the whole thing was unraveling. In March, Enron's deal with Blockbuster to stream movies on demand collapsed. The stock fell to the 60s. Then more deals went sour. Investments that were supposed to print money started bleeding cash. In August, Jeffrey Skilling abruptly resigned as CEO after only 6 months. He cited personal reasons. the stock dropped below $40. Then, in October, Enron announced it was restating 4 years of earnings. It had overstated profits by nearly $600 million and hidden $628 million in liabilities. The stock collapsed to under $10. Dynegy, a smaller energy company, tried to buy Enron in a last-ditch rescue. But when Dynegy's lawyers started digging into Enron's books, they found billions in hidden off-balance sheet debt. The deal died. On November 30, 2001, Enron's stock closed at 26 cents. On December 2nd, the company filed for bankruptcy. At the time, it was the largest bankruptcy in U.S. history. $74 billion in market value. Gone. But the real damage was to the employees. Enron's 401k retirement plan had over 60% of its assets in Enron stock. The company matched employee contributions with its own shares, and it didn't let employees sell that stock until they turned 50. So when the stock crashed, employees couldn't get out. They just watched. At the end of 2000, the plan held $2.1 billion. By late 2001, it was nearly worthless. Thousands of workers lost their entire retirement savings. Some lost $600,000, $800,000, everything. And while they were losing everything, executives like Skilling and Lay were selling their shares at the peak. Skilling sold $22 million worth before resigning. Lay sold hundreds of millions. They knew, and they got out. Here's the part that makes this worse. Enron wasn't just cooking the books. It was actively manipulating energy markets and causing real harm. In 2000 and 2001, California experienced rolling blackouts. Power grids failed, hospitals ran on backup generators, the state paid billions in emergency energy costs. Enron traders had created fake shortages. They moved energy out of California just to move it back in at inflated prices. They created artificial congestion on power lines to get paid to relieve it without actually moving any electricity. They gave these strategies names: Fat Boy, Death Star, Get Shorty, Ricochet. Internal memos documented the whole scheme. And when regulators finally saw them after the bankruptcy, it became clear Enron had deliberately caused an energy crisis to profit from it. People's lights went out, not because there wasn't enough power, because Enron wanted higher prices. And what happened to the people responsible? Jeffrey Skilling was convicted on 19 counts of fraud and conspiracy. He got 24 years, later reduced to 14. Kenneth Lay was convicted on all 6 counts, but he died of a heart attack before sentencing, so his conviction was vacated. Andrew Fastow, the CFO who ran the fraudulent partnerships, pleaded guilty and got 6 years. Arthur Andersen, Enron's accounting firm, was found guilty of obstruction of justice for shredding documents. The conviction was later overturned, but by then the firm had lost all its clients. 85,000 people lost their jobs. Enron employees and shareholders got almost nothing back. Bigger implications, 10 o'clock to 11:30, so what did Enron actually prove? It proved that mark-to-market accounting can be weaponized, that off-balance sheet entities can hide almost anything, that auditors can be complicit or blind, that regulators can be asleep, and that when everyone profits from a lie, no one asks questions until it's too late. After Enron, Congress passed the Sarbanes-Oxley Act. New rules, new penalties. CEOs and CFOs now have to personally certify their financial statements. Auditors have stricter independence requirements. But here's the uncomfortable truth. Enron didn't break the system. It used the system. Almost everything it did was technically legal when it started. The loopholes existed. The accounting tricks were allowed. The partnerships were permitted. Enron just pushed every loophole to its absolute limit, and by the time anyone realized what was happening, $74 billion had evaporated and thousands of lives were destroyed. The company that was named the most innovative in America 6 years running turned out to be the most innovative at fraud, and the people who built it, they convinced themselves they were geniuses, visionaries, masters of the universe. Right up until they weren't. Here's the question no one really answered. If Enron's executives genuinely believed their own hype, if they thought mark-to-market made sense and their energy trading was revolutionary, were they fraudsters or just delusional? Because the memos, the trials, the convictions, they tell one story, but the interviews with former employees tell another. A lot of them thought they were changing the world, that they were building something real. Maybe that's the scariest part. Enron didn't fail because it was run by cartoonish villains. It failed because smart people convinced themselves that the rules didn't apply. That growth justified anything, that as long as the stock went up, nothing else mattered. And 25 years later, we still see companies that prioritize hype over fundamentals, that promise innovation but deliver accounting tricks, that reward executives for short-term stock price gains while employees hold all the risk. Enron didn't invent that playbook, but it perfected it, and we're still using it.